Okay, hi there. In this video, we're going to ask the question, to what extent can changes in interest rates affect short-run and long-run aggregate supply in an economy? Well, monetary policy has been tightened in the UK in recent times, with the Bank of England raising their main policy interest rate in a bid to control inflation. And this chart shows the path of UK's policy interest rates from January 2018 all the way through the pandemic, when they were cut to 0.1%, right the way through to January 2023, where base rates at the time of this recording were 4%. There have been 10 successive increases in the base rate as the Bank of England has tightened monetary policy. So how might higher interest rates affect aggregate supply? Well, monetary policy is an example of a demand-side policy that essentially seeks to influence the level and growth of aggregate demand. But it's important to recognise that changes in interest rates and also the exchange rate can also have an impact on the supply side of an economy. For example, as we'll discuss, by affecting planned business capital investment. So how can high interest rates affect supply? Well, first of all, when interest rates in the economy are going up, money becomes more expensive to borrow. So firms will have to pay more for a business loan or perhaps an overdraft, and certainly a loan if they're going to finance their investment. And if investment goes down, if gross investment, for example, is below depreciation of capital, then that could lead to a possible decrease in long-run aggregate supply. Linked with this, if firms are investing less in new capital, new technology, hardware and software, for example, that's going to mean that the economy's capital stock will age. And as the capital stock ages, it tends to break down more frequently, and that can lead to a fall in productivity and a fall in efficiency. Again, two factors that are affecting aggregate supply. And higher interest rates, through their effect on demand, may well reduce the profitability of many businesses, particularly in sectors where demand is sensitive to the rate of interest. One thinks, for example, of new cars, home improvements, and so on and so forth. So if profits go down, then businesses may have less to spend on their own research and development and invention and innovation. And over time, again, that might lead to a fall in labour productivity. So there are certain channels by which a rise in interest rates could have a negative effect on aggregate supply. But in evaluation, higher interest rates usually cause an appreciation of a country's exchange rate because of an inflow of hot money. And if the pound or the dollar or the euro, for example, is stronger, that can allow domestic businesses to buy imported capital equipment, imported software, imported new technology at a lower price. And if investment becomes cheaper, that could cause capital spending to go up. Indeed, for many countries, much of the capital inputs that businesses invest in are sourced from overseas. A second related point is that higher interest rates are designed as a policy by a central bank to help control inflation. And if that is successful, then lower inflation going forward will help to improve macroeconomic stability and help to cement and improve business confidence. And when business confidence is stronger, when the uncertainty of high and volatile inflation is lowered, that in turn can help promote investment demand. And thirdly, higher interest rates can encourage households to save. The propensity to save might go up, leading to an increase in deposits put into the banking system, which in theory again might increase the pool of funds available for lending to businesses. Potentially, if the supply of loanable funds goes up, that might bring down the cost of borrowing going forward, making it easier and cheaper for businesses to access finance. So in theory, there are some other ways in which higher interest rates could be beneficial for aggregate supply through the investment channel. And appreciation of the exchange rate, I think, is a really key point. If the pound goes up against the US dollar, for example, imported technologies from the United States become cheaper. Now, changes in interest rates do not normally affect short-run aggregate supply because the interest rate on a loan, the interest payment on a loan or an overdraft, is normally regarded as a fixed cost rather than a variable cost of production. So probably best not to shift the short-run aggregate supply when you're discussing a rise in interest rates. However, cyclical changes in interest rates can affect aggregate supply indirectly by controlling the growth of aggregate demand, perhaps to a level near the output gap level, potential output, that guides aggregate supply up or down to its sustainable potential level. So there we go. Hopefully this explains how indirectly interest rates could affect aggregate supply.